So this video is inspired by a question that one of my YouTube subscribers asked me yesterday. Yesterday, I spoke about point number one in the base, how to identify it. On that video, I received a comment about volume. One of my YouTube subscribers wanted some clarity on how to look at volume inside the base, outside the base, etc. That inspired me to create uh, 5 chart examples for you. So there are 5 charts here. So this is Tata investment. Look at this breakout. Then the IRFC breakout, the ITI breakout, the Garden Reach shipping breakout. Of course, all of these are old chart examples. As per the regulations, I have to show you only the old charts. So you see, I have taken old chart examples. All of these are examples of breakouts. So using these examples, I want to talk about volume. Plus, I also want to talk about what is common in all of these 5 charts. So this video could become a 2 part or a 3 part video series. I don't know. I have just started talking about it. As you know, I don't plan my videos. I just hit the recording button and whatever comes to my mind, it is just flowing through me. There is no script here. Okay. It's just coming naturally from my knowledge and experience in the market. So this could become a 2 part or a 3 part or maybe a 4 part video series. I don't know. Let's start the discussion. In this video, let us focus specifically on volume because I want to break up this video into multiple parts so that it is easy for you to consume or digest this information. Okay. So this, when we say volume, we are talking technical analysis. Okay. So I always, when I start talking about a particular chart, I give you context. The context is my orange trading framework. Okay. So this is the orange trading framework, which you already know if you have been on this channel for some time. So these 5 circles, this is the stock selection criteria. Then you have position sizing, trade execution, risk management, trade management, and stock filtering. So stock selection, trade execution, trade management. These are the 3 skills that you have to master. Within stock selection, you've got something called as technical analysis. In technical analysis, we look at price and volume. This video is about that technical analysis, which means this video is about stock selection, looking at a particular base and deciding whether that stock is really worth my time or not. Okay. Next slide. To directly answer the question that one of my subscribers asked me, here is a diagram. Okay. So remember what I had taught you earlier. Step number one is high volume rally. Step number two is low volume consolidation. And step number three is high volume breakout. If you understand this diagram, you will never feel confused about volume ever again. And I will show you 5 examples of how this gets manifested on the chart. Remember, the chart is an effect, it is not a cause. I will tell you what is the cause. So, in the market, there are 2 kinds of participants: retail participants and institutional participants. Institutional participants are the big money. Retail participants are people like you and me, the individual retail traders or investors in the market. So, whenever there is a high volume rally, both the retail participants and institutional participants are piling onto the stock. Okay, they are scrambling to get hold of the stock because every stock has a limited number of share supply. Okay, and people want that. So people are willing to pay a higher price to get hold of that stock. Maybe they did their research and they found out that this company is likely to grow in the future. So they want to become a shareholder of that company. Whatever may be the reason, in a high volume rally, both the retail participants and institutional participants are piling onto the stock. There is a scramble to get hold of that stock because supply is limited. Then comes a point where the retail people start to book their profits. The institutions don't want to book their profits because their research shows that this is a long term play. They want to hold on to the stock. So the retail participants begin to sell some of their shares. Now, you tell me, when the retail people are selling, who do you think is buying? The institutional participants, right? That is why during this period, the exchange of shares are happening. The shares are going from the hands of retail participants to institutional participants, which means the institutional participants are accumulating the stock. That is why this period is called as the accumulation. Remember stage 2 confirmed uptrend, where the 50-day moving average is above the 150-day and the 150 days moving average is above the 200-day. That is called as the accumulation phase. In accumulation, the shares are going from retail participants to institutional participants. And imagine in this period, consolidation period, since the shares are going from retail to institutional, it means that the retail participants are selling, not the institutions. Now, since the retail participants are selling, that is why the volume is low. Because when retail people are selling, they don't sell with huge volume. When an institution is selling, they might offload like 2 million, 3 million shares in one shot. That does not happen with retail participants. The number of retail participants is large, and the average number of shares held by retail participants is small. So they sell in bits and pieces. That is why the volume during this period is low. So now you understand the logic behind what is happening. Why do we say low volume consolidation? Why do we say high volume rally? Remember basic principle. Whenever we talk about high volume, it is institutions at play. Whenever we talk about low volume, it is retail participants at play. Okay. So during this period, since the retail supply is coming to the market, the volume is low. If institutional supply was coming, the volume would not be low. Okay. Then comes the high volume breakout, because there comes a time during this consolidation where the retail participants are not available anymore, because whoever retail participants were there who had held on to the stock, now they are exhausted. So now most probably only institutions are holding on to the stock. So why do you think a high volume breakout occurs? See, the number of shares of a company are limited. Okay. That too, out of those shares, the number of shares available for trading, which is free float, even that is a limited number. And if that is held by institutions, then if another institution wants to buy stock in that company, they will have to buy it from some other institutions, right? And when two institutions are having a deal, okay, that deal consists of a lot of shares. It is not 100 or 200 shares. So it's like two dinosaurs fighting with each other. Remember Jurassic Park movie? Two big dinosaurs fighting with each other. That is what is happening here, because there are no more retail participants left which are holding on to the stock, and whoever are left, they are not willing to sell their stock. So if I am a fund manager with 5,000 crore capital and I want to buy this stock from another institution, I will have to pay a premium. If I don't pay a premium, these shareholders will not sell their shares, because this is the stock market is an auction market. I have to entice the existing shareholders to sell. And how can I entice? Only way is to entice is with price and huge block of shares, huge volume. Okay. That is why this breakout comes at high volume. Okay. So remember, high, low, high. So if you understood this explanation, you will never feel confused about volume. Okay. Let's go to examples of those. Let's go to those 5 chart examples to see this in action. It is very, very evident on the chart. Okay, it is very, very clear now. If you have understood this explanation, charts will become very easy for you to understand. So remember, step number 1, high volume rally. Retailers and institutions are piling onto the stock. Step number two, low volume consolidation. The retailers are selling their stock to the institutional players. And step number three, high volume breakout. Institutions are trying to snatch the stock away from other institutions with high volume. Okay. Going to chart examples. So this is the first chart, Tata investment. See step number one, high volume rally. So this is the high volume rally. Look at the volume here. See the blue line that you see here, that is the 50-day simple moving average of volume. Whenever the volume bar is above that blue line, that is called high volume. Whenever that volume bar is below the blue line, that is called low volume. And whenever the volume bar is at the blue line, that is called average volume. You see here, most of these green bars, okay, are above, way above average. Okay. Some of them are 400%, 500%, 900% above the average. If you notice this, look at this blue is called as the average volume, green is called as the actual. See, for this candle, the average is 219,000 shares, but the actual is 2.5 million shares. It's almost 10 times the average volume. It's like 900% above the average volume. Okay. That is called high volume rally. So, high volume rally, the retail participants and institutional participants both are piling onto the stock. Majorly, it is retail participants. Okay. Then suddenly you see the volume drops. Okay. You see most of these bars are below that blue line. Okay. Especially the red bars. Red bar means the red candle, the price is coming down. Correct. So when the price is coming down, it is like the retail participants giving their shares to the institutional participants. The institutional participants are very happy accumulating the stock because they are getting the stock at a lower price, or they are getting the stock at a reasonable price. Here they had to pay more to acquire the stock, but now the natural supply is coming from the market. Retail participants have started booking their profits, right? So since that natural supply is coming, institutional participants don't have to entice other people to sell. Why do you need to entice other people to sell when they are already willing to sell, right? When they're already willing to book profit, you don't need to entice them. Whatever price they are offering, you take it. That is what is happening here. So during this entire phase, the volume has remained very low. You see how it is playing out. High volume rally, low volume consolidation, and suddenly the stock shoots up like 2%, 20% in a single day. And the next day it shoots up another 15-20% in a single day, that too on high volume. Where did this volume come? Right? Since so many days, from October to November to mid November, almost 1.5 months, there was hardly any volume. Now, suddenly, where did the volume come from? Well, it came because two dinosaurs started fighting with each other, right? You have to offer a higher price. You have to offer a premium price if you want to get hold of the stock. And by the way, if you notice this chart after this candle, it formed another base, and from that base, it again broke out. Okay, so a good stock continues to form bases when it is in a stage 2 confirmed uptrend. Okay. So high volume rally, low volume consolidation, high volume breakout. Most of the candles in the low volume consolidation should have lower volume. Most of the candles during high volume rally should have higher volume above the blue line. And at the breakout, obviously, we need a high volume breakout. So this is Tata investment. Let's look at the next chart. So this is IRFC. This was in 14 December 2023 that breakout happened. After this, I think the stock shot up 86% in a month. Okay. So have a look at this. See, from here till here, or from here till here, look at the volume bars here. Compare these volume bars with these volume bars. So From here to here, that is a high volume rally. Look at these bars. Most of them are above the blue line. Then suddenly it starts to form a base. Most of the candles have volume below the blue line. Most of the candles. I'm not saying each candle should have volume below the blue line. I'm saying most of the candles. Okay. And then obviously the high volume breakout. Look at the average volume on this candle. It was 58 million. And how many shares were traded? Look here. How many shares were traded? 475 million shares traded in a single day when the average volume is 58 million shares. That is called as high volume breakout. See, retail participants will buy 100 shares, 200,000, maybe 2,000 shares. You cannot buy million shares. For someone to buy millions of shares of a company, it has to be an institution. This is not retail participants buying the stock. When millions of shares are traded, it is institutions in action. Okay. So again, step number one, high volume rally. Step number two, low volume consolidation. Step number three, high volume breakout. Example number three. This example I have shown you in the previous video where I spoke about the 52-week high. I helped you understand how to identify point one in the base. But in that video, I did not discuss volume. Okay. Look here. From here to here, look at these volume bars. Okay. Do you notice another base here? See, high volume rally from here to here, low volume consolidation here, and then high volume breakout here. Again, high volume rally from here to here, low volume consolidation from here till here, and then high volume breakout. Look at the volume there. Average volume is 4 million, and on that day, 45 million shares traded. 10 times more than average volume, like 900, 1000% more volume than the average daily volume. When 45 million shares are traded, it's not retail participants who are buying the stock. It is institutional people who are buying the stock in bulk. That is called as a true breakout. And looking at these chart examples, you will realize that if you want to identify a true breakout in the market, generally what happens is in the morning, 15 minutes, half an hour, 1 hour itself, the volume breaches the blue line. Okay, that's a true breakout in my experience. Because if the volume has to close like 900% above the blue line, it has to cross the blue line quickly in 15 minutes, half an hour, 1 hour. It has to cross that line. Only then you can say that, okay, by the end of the day, the volume is going to be considerably higher. So in whenever you have a stock on your watch list, and in the first half an hour, 1 hour, you don't see much volume action, it's probably not going to be a breakout day. It probably doesn't make sense to put in a GTT order. At least you can put an alert, but doesn't make sense to put a GTT order, which is an automatic buy order, because it is too risky. See, a true breakout will not give you a chance to buy the stock. You have to buy it quickly. Okay, that's a true breakout. If a stock is giving you too much time to buy, that means it is not a true breakout. Okay, next example. GRSC, Garden Reach Shipping Company. See, high volume rally here, low volume consolidation, see, low volume, and then suddenly high volume breakout. This stock shot up like 85% in 3 weeks. Okay, that's the power of this breakout. Okay, step number one, high volume rally. Step number two, low volume consolidation. Step number three, high volume breakout. Tell me, is that rocket science? It's very, very simple. I cannot simplify it more than what I am doing right now. Okay, next. After this video, you should not be confused about volume. Okay, see, look at these candles when the price is going up. Look at these volume bars. Very high volume coming in there. This is persistent systems. Very high volume. Then it starts to form a base. Most of the red bars are below that blue line. And then suddenly the breakout comes. 1.9 million shares traded. Average volume 802,000, which means the actual volume is 100% above the average daily volume, correct? It's almost double the average daily volume, correct? That's a true breakout, right? So we looked at 5 examples, and the moral of the story is high volume rally, low volume consolidation, high volume breakout. In real time, when you are trading, you don't see the step number 3. You see step 1, step 2, high volume rally, low volume consolidation. Even if you are able to spot step 1 and step 2, that is more than enough, because step 3 we can catch while executing the trade. When executing the trade, we can check volume on the lower time frame charts like 5 minute, 15 minute, 30 minute, or 1 hour time frame. If we see considerable amount of volume coming in a very short period of time, we could assume that that is probably going to be a high volume breakout day, and we could think of taking a position there. Okay, thank you so much. I think I will make uh, more parts on the same 5 chart examples. I wanted to discuss some more things. For example, if we look at these 5 chart examples, there are certain things that are common in all of these 5 chart examples. Okay. And I want to discuss what are those common things, so that you will be able to spot a particular base. You will be able to spot a stock just before it is going to break out. So I think I will do part 2 of this video. Consider this please as part number 1. I think I might also do part number 3, because in part number 3, I want to discuss the mother baby candle combination. So let's see how this goes. If I'm able to discuss the mother baby candle combination in part 2, I will do that. But I want to break this video into multiple parts so that it is easy to consume, digest. So high volume rally, low volume consolidation, high volume breakout. Just remember that from this video. Okay.